50 years ago, America went through the perfect financial storm. Inflation was surging, oil prices were exploding higher, and the economy was slowing down at the same time. This was not just a brief period of instability, it was a fundamental shift in the global financial order that completely crushed the purchasing power of the average citizen and destroyed fortunes that had taken generations to build. But hidden within that terrifying macroeconomic situation was a lucrative wealth-building opportunity for a very specific type of investor. Today, we are staring down the barrel of a nearly identical setup, a historic macroeconomic alignment that only happens once every 50 years, and it is happening again right now as we speak. The fear, the panic, and the uncertainty are all echoing the exact same patterns we saw half a century ago. You are likely feeling the stress of this right now, watching your grocery bills climb, seeing the purchasing power of your hard-earned nominal dollars evaporate, and wondering how you can possibly protect your family financial future when the entire system feels incredibly unstable. The media wants you to panic, but history tells us a completely different story. History shows us that wealth is never truly destroyed in these moments of crisis. It is simply transferred from the uninformed herd to the prepared opportunists who understand exactly how to position themselves. To understand what that means for you today, we have to look back at the original perfect financial storm that began in the early 1970s. In 1971, President Richard Nixon made a shocking announcement that completely severed the United States dollar from the gold standard, effectively ending the Bretton Woods system and unleashing a tidal wave of fiat monetary expansion. Suddenly, the central bank had the ability to print money without the constraints of physical gold backing, and the result was an immediate and violent devaluation of the currency. But that was only the first domino to fall. Shortly after this monumental policy shift, the world was hit by the 1973 oil shock, where geopolitical conflicts in the Middle East led to a devastating embargo that sent energy prices exploding higher overnight. Sound familiar? The combination of rampant monetary expansion and severe supply chain constraints created a toxic economic cocktail known as stagflation, a prolonged period of high inflation, high unemployment, and stagnant economic growth. During this time, the traditional rules of investing were completely flipped upside down. People who thought they were playing it safe were absolutely crushed by the invisible tax of inflation, while those who understood the new rules of the game managed to build immense generational wealth. The Federal Reserve was forced to become aggressively hawkish, drastically raising interest rates to combat the very inflation their policies had helped create, which only added to the immense pain felt by the middle class. Businesses struggled to maintain profit margins, consumers stopped spending, and the broader stock market went through a grueling decade of massive drawdowns and brutal volatility. Yet amidst all this chaos, certain assets were quietly compounding at staggering rates, quietly making incredible fortunes for the few investors who had the foresight to ignore the mainstream hype and focus on the underlying macroeconomic reality. They recognize that when the cost of capital skyrockets and the purchasing power of fiat currency plummets, the traditional portfolio of stocks and bonds is no longer a safe haven, but rather a sinking ship. This historical case study is absolutely critical because it serves as the ultimate blueprint for what we are navigating today. The investors who survived and thrived during the 1970s did not do so by blindly throwing money at the market or hiding their cash under a mattress. They did it by deeply analyzing the structural changes in the global economy and radically shifting their capital into areas that directly benefited from the crisis. They understood the mechanics of inflation, they tracked the flow of liquidity, and they completely detached their emotions from their investment strategy. Fast forward to today, and the parallels to that bygone era are absolutely staggering, painting a picture of the late 2020s that feels like a modern-day reboot of the 1970s stagflation crisis. We have just lived through a period of unprecedented, record-breaking monetary printing, where trillions of dollars were injected directly into the global financial system, vastly expanding the money supply in a matter of months and setting the stage for the surging inflation we are battling right now. Just like in the 70s, we are witnessing severe geopolitical conflicts erupting across the Middle East and Eastern Europe, completely disrupting global supply chains and putting massive upward pressure on energy markets and critical commodities. But today, we have an added layer of complexity that the investors of the 70s never had to contend with: the rapid exponential acceleration of artificial intelligence and the massive capital requirements needed to build out the global infrastructure. This technological arms race is creating a massive drain on energy grids and semiconductor supply chains, effectively acting as a modern-day equivalent to the oil shocks of the past, but driven by data centers rather than combustion engines. We are looking at a scenario where inflation remains stubbornly sticky. The Federal Reserve is trapped between fighting rising prices and preventing a massive recession. And the broader economy is clearly slowing down under the immense weight of hawkish interest rate policies. This is the exact same toxic economic cocktail of stagflation, just poured into a slightly different glass. If you are sitting there wondering why your investments are experiencing violent drawdowns or why your paycheck does not stretch nearly as far as it did just 3 years ago, this is exactly why. The macroeconomic tectonic plates are shifting beneath our feet, and the financial strategies that worked brilliantly during the massive bull market of the last decade are now completely obsolete. The era of cheap money, 0% interest rates, and endless liquidity is officially over, and we are now entering a highly volatile regime where only the most adaptable and educated investors will survive. This brings us to a crucial crossroad, a moment where you have to honestly evaluate your own financial strategy and ask yourself if you are truly prepared for what comes next, or if you are simply hoping that things will magically return to normal. To truly illustrate the stakes of this moment, let us look at a fascinating 10-year case study from that original 1970s crisis, broken down through the lens of 3 distinct types of investors: the saver, the index investor, and the opportunist. First, we have the saver. This is the person who is terrified by the market volatility and decided to play it completely safe, keeping all of their hard-earned money in cash or low-yielding bank accounts. On paper, they did not lose a single nominal dollar, and they probably slept relatively well at night thinking their money was secure. But in reality, they were absolutely crushed. Over that 10-year period, rampant inflation silently eroded their purchasing power by more than half, meaning their seemingly safe cash could only buy a fraction of the goods, services, and real estate it could a decade prior. The saver was the ultimate loser of the decade, completely destroyed by the invisible tax of monetary debasement. Next, we have the index investor. This person followed the conventional wisdom, buying and holding a broad basket of large-cap American equities, trusting that the market always goes up over time. During this stagflationary decade, the broader market experienced wild, nauseating swings, suffering massive drawdowns that tested the conviction of even the most seasoned market veterans. When you adjust their returns for inflation, the index investor essentially went nowhere for an entire decade, generating a real return of roughly 0 after enduring years of extreme stress and emotional pain. They did not lose their shirt like the saver, but they completely failed to build any true generational wealth. Finally, we have the opportunist. This investor recognized the macroeconomic shift early, understood that fiat currency was being actively devalued, and aggressively rotated their capital into hard assets, specifically gold, which acted as the ultimate inflation hedge during this specific decade. As the dollar plummeted and oil prices skyrocketed, gold went on a legendary historic run, exploding from $35 an ounce to over $800 an ounce. The opportunist absolutely crushed the market, utilizing this unique, once-in-a-lifetime setup to exponentially level up their net worth and achieve massive financial independence. They capitalized on the chaos, detaching from the emotional panic of the herd and executing a calculated, thesis-driven strategy that perfectly aligned with the inflationary reality of the time. This 10-year window proves exactly why you cannot simply sit on your hands during a major macroeconomic shift. But here is the massive plot twist that almost everyone completely misses when they study this period of financial history. And it is the single most important lesson you need to understand if you want to successfully navigate the coming decade. Let us extend the timeline of our case study from a 10-year window to a 20-year window, stretching from 1971 all the way to 1991. If you had looked at the massive success of the opportunist in 1980 and decided that gold was the only asset you ever needed to own, you would have made a catastrophic wealth-destroying mistake. Why did gold lag so terribly in the second half of this 20-year period? Because eventually the hawkish policies of the Federal Reserve actually worked. Interest rates were pushed to mid-teen percentages, inflation was finally broken, and the underlying economy began to fundamentally restructure and recover. As inflation expectations collapsed, the massive premium that had been priced into gold evaporated, and the precious metal entered a brutal, multi-decade bear market. Meanwhile, the index investor who had suffered through a decade of zero real returns suddenly saw their patience rewarded in the most spectacular way imaginable. As the cost of capital eventually stabilized and corporate earnings began to re-accelerate, the broad stock market embarked on one of the greatest, most lucrative bull runs in human history. The companies that had survived the stagflationary fire were now leaner, more efficient, and incredibly profitable. The broad market vastly outperformed gold over the full 20-year timeline, proving that while hard assets are phenomenal tactical tools during acute inflationary shocks, productive businesses that generate compounding cash flows are the ultimate engine for long-term generational wealth. This reveals a profound truth about the nature of investing. There is no single magical asset class that works perfectly in every single economic environment. The superstar investment of one decade can easily become the dead weight of the next. To build and maintain true fortunes, you have to be dynamic. You have to be willing to adapt your thesis as the macroeconomic facts change, and you must understand the critical difference between a short-term opportunistic trade and a long-term compounding wealth machine. So what exactly does all of this historical analysis mean for your portfolio right now, as we navigate this modern-day repetition of the 1970s? It means you have to completely rethink your asset allocation and aggressively position yourself in the sectors that are fundamentally designed to thrive in a world of sticky inflation, massive geopolitical tension, and constrained resources. If supply chains continue to tighten and deglobalization accelerates, the companies that control scarce essential inputs are going to benefit massively. We are actively rotating capital into highly specific, robust sectors of the economy. First, we are targeting the energy sector, but not just traditional oil and gas. We are looking at the companies providing the critical base load power required to run the massive, energy-hungry data centers powering the artificial intelligence revolution, as well as the uranium miners and nuclear infrastructure companies that offer the only viable path to clean, scalable energy independence. Second, we are deeply focused on the defense and aerospace sector. As global instability rises and the unipolar world order fractures, sovereign nations are being forced to dramatically increase their military spending, creating a massive multi-decade tailwind for the top-tier defense contractors who supply the advanced weaponry, cybersecurity, and aerospace technology necessary for national security. Third, we are aggressively accumulating positions in the fundamental infrastructure layer, the semiconductor manufacturers, the specialized cooling companies, and the data center real estate investment trusts that are literally building the physical backbone of the next technological era. These are the modern-day equivalents of the hard assets that the opportunist bought 50 years ago. but they possess the added benefit of actually generating massive compounding cash flows. When you combine the inflation hedging characteristics of a hard asset with the massive scalable profit margins of a modern technology or energy monopoly, you create an incredibly resilient portfolio that is practically immune to the chaotic monetary expansion policies of the central banks. This is exactly how the smart money is positioning itself right now, quietly accumulating these superstar companies while the retail crowd is paralyzed by fear and uncertainty, completely unaware that the greatest generational wealth-building event of our lifetime is unfolding right before their eyes. You absolutely must act decisively. You cannot afford to be the passive saver right now, slowly bleeding out your purchasing power, and you cannot afford to blindly buy the broad market without a deep understanding of which specific sectors are actually driving the growth. You have to be the disciplined, educated opportunist. If you want to go deeper with me, get the exact stocks I am buying, exclusive weekly videos, and deeper market research inside Wealth Academy, click the join button below or the link in the description. The window of opportunity to position yourself for this wealth transfer is rapidly closing, and the decisions you make with your capital over the next 12 to 18 months will dictate your family financial trajectory for the next 3 decades. Do not let fear paralyze you. Do not let the mainstream media narrative blind you to the massive opportunities hiding in plain sight. And do not settle for average returns when you have the chance to completely level up your financial reality. Educate yourself, build a highly targeted, thesis-driven portfolio, constantly reinvest your compounding dividends, and take absolute control of your financial destiny before the perfect financial storm hits.